Welcome to the Metro Blue Capital Podcast, the real estate investing education domain. Tune in for interviews and discussions with successful real estate investors and entrepreneurs. They share their knowledge, experience, and key advice on how to build cash flow from real estate and achieve financial freedom. Let's get started.
Hi, thank you for tuning in to today's podcast. I'd like to introduce a special guest, Robert Shemin, serial entrepreneur, motivational speaker, successful real estate investor, and mentor with thousands of students across the globe. Founder of Project X, philanthropist, and founder of organizations that help feed the needy. Wealth advisor for CNN, Fox News, New York Times, The Wall Street Journal, best-selling author of 16 titles, attorney, and wonderful father. Robert, thanks so much for joining today.
Oh, good to see you, Eric. How have you been? Everything good?
Good, thank God. Can't complain, thank God.
And welcome to everyone who's listening. You're going to learn some really good stuff. And congratulations, Eric, on your investing and what you've done and getting started and doing good things. And I work with a lot of investors, as you know, and you are thorough. You are a man of action. So just want to say congratulations to you.
I appreciate it.
Glad to be here.
Yep.
Welcome, everyone.
Welcome. I was wanting to ask you if you can tell us a little bit about your multifamily investing experience, history, and successes you've had with multifamily.
So if you don't mind, I was scared to death to do any investing. I found a mentor and started out with houses and duplexes, like a lot of people. And I'll never do a big deal. It's too scary, too much money. And I did well with the houses and duplexes. And it took me, and please don't take this long, about 7 years and I saw my friends making a lot of money in multifamily, and everything has advantages, disadvantages. And I used to manage my own property, and I've done many multifamily, starting out with small ones like 5 to 10 units, and then graduating with partners into the bigger things like 50, 150, 90, 200, 300, mainly some C, some B, and some A minus. Some needed a lot of work, some needed a little. And it was amazing because, like anything, once you do it and know what you're doing, of course, it's pretty easy. And there's so many advantages to doing those multifamily deals. And by the way, we've been through a lot the last couple of months, as you know. And, people always need a place to live. As long as you know what you're doing and do it right, which I know you are doing it, you can really do well. And there's economies of scale. And the numbers are nice. And again, there's niches in that market, which we try to find in certain areas that need work, or tired landlords, motivated sellers. And it's been amazing. And there's always an opportunity. Again, I want people to think about every time you drive by an apartment building, a big one, a nice one, a medium-sized one, someone owns it. Someone is cash flowing it, hopefully. They bought it right like they should. Someone is probably managing it, not them. You manage the managers. So you're more free than having to manage things. And there's a lot of tax advantages. Tenants are paying off your debt if there's debt. And over time, if you buy right, know what you're doing, does very, very well generally. And I love it.
Yeah, it's a great investment. Multifamily, it's so solid. What are some key benefits that you would suggest to investors that are looking to diversify their portfolio or to fulfill any goals of possible financial freedom with multifamily investing?
Well, as you know, Eric, I've done pretty much every type of investing there is. Stocks. I know you've done different things, financial instruments, and I love apartment buildings because you can see them, feel them, touch them. You can pretty much always rent them. Yeah, there's ups and downs and cycles and things, but if you manage them very well and know what you're doing, you can always fill them up. And the big thing is economies of scale. For real estate, the two, I guess risks or challenges, as you and I know from doing it, are repairs and management. When you have some houses or some duplexes, you got to run around to different areas to check them out and repair them. When you get over like 80, 90, 100 units, depending on what you're doing, or 50, maybe 120, everybody's a little different. You get on-site management, and you can go fix them, repair them, manage them, do the repairs all at once if you're buying them to add value, which is what I know you're interested in doing and I've done. So it's actually a little more professional, a little more easier to manage them and to repair them. And you can actually save some money doing that, as opposed to, and I love houses and duplexes and new construction, but you can really have some economies of scale, and the numbers can be quite nice, the returns, because a lot of people right now have lost money in the market. Some have made money. Interest rates are low, so they're not making a lot of money. And we're seeing a lot of investors right now who have money, believe it or not, saying, what do I do with it? And I think diversification is a key. So I challenge all my friends who are really smart and say, listen, I know you've done well in the markets, the mutual funds, but I believe real estate, as you know, most billionaires, multimillionaires have real estate in their portfolio. And a lot of it is, I think one of the safer ones, multifamily.
Yep. And if you have good systems that you implement in place, management and whatnot, I mean, I believe Warren Buffett once said that if you cannot produce income while you're sleeping, you'll work to the last day of your life. Right. And I think it's a good way to do that, to fill that goal on financial freedom. And you buy right. And a lot of these buildings have, they've been throwing off money for over 100 years. A building that I have is like 110, 120 years old, still throwing off money. A lot of these mom and pop owned places are multifamilies. They're mismanaged, or they're just a lot of opportunity. You just got to look at them and run the numbers and do your due diligence. And there are a lot of deals out there. A lot of people age. They want to get out of a deal. Someone passes away. Partners break up. So there are a lot of opportunities like that.
So you make money a couple ways. You value add, so your equity goes up. You create equity. You buy below market from motivated sellers. You have the cash flow, the tax benefits, and what I love, it's for savings. If you have debt, the tenants are paying your debt off. And I've been, people always worry, is now the time? And I've been doing real estate since '94, and it's amazing. You got to know what you're doing. There's always risk, but the rent comes in.
Yep.
Every week, every month. I've been through wars, recession, elections, viruses, all kinds of stuff. And, people need a place to live. It's a basic thing. And if you, treat them well and buy the right types of property, we make money in C property, B property, A- property, and lots of opportunity. And, you have to know what you're doing, which I know you do, because you're one of those people like me. You study, you learn, you do your research. I know how you research these deals. And, some investors just go out and, somebody says, oh, we have a deal, and it looks nice, a nice thing, and they invest. And you got to know what you're doing in anything. And I know that's something that you have worked really hard at.
Thank you. Yeah. Well, extreme due diligence is very important to make sure you do I always recommend learning, having a coach, mentor, buying books, investing in yourself and education, just getting smarter at it, and learning from other people's mistakes ultimately saves you a substantial amount of time and money. So, you spend a lot of time talking, going to real estate meetups, meeting people, asking advice, reading books, learning how to verify numbers on a property. You always mention verify. It's very important to do that. It's crazy in June right now, this is being recorded, June 2020, with the pandemic and everything going on. Thank God my properties are 100% occupied and there are no delinquencies. And this started in March.
Nice.
And we show compassion towards the tenants. I've instructed the property management company to contact them, ask them if they need anything, if everything's okay. We let them know that rent's still due on the 1st or whenever the rent is due. But if we can be of any assistance with anything, if they need anything.
Nice.
And that compassion is they appreciate it very much. And surprisingly, a lot of tenants have just called and said, hey, I just want to let you know, with everything going on, we intend on paying, we're paying rent, everything's okay, or I'm getting unemployment, or I'm working. And they've contacted us before we even reached out to them, which is, pretty surprising. I also suggested that we've dropped boxes of food off to some families.
Nice.
Some units. So just showing that compassion and helping out and waiving late fees and things like that really makes a big difference. And just have to be kind to people. I firmly believe in karma. You're good to people, it comes back to you tenfold.
I'm so glad you said that, because that's why I got the business. And I know you do it too. The same philosophy is treat your tenants, whether they're low income, middle income, high and middle income, doesn't matter, like valued customers. Take care of them. Your managers, they're people.
They're feeding you and your family.
And a lot of companies don't do that, or don't know how to do it, or don't want to do it. And, sometimes they still do well, and a lot of times they have problems, but, it takes someone who's involved. I've been on both sides. I'm the investor sometimes. I put the money in. I'm also, like you, the person who puts the deals together, manages the managers, make sure it goes well. And that's very important because not many people really do that in the real world. And I'm glad you're doing that.
Thank you. Yeah, exactly. Yeah, it's really important to, yeah.
It's a people business. Yeah, there's apartments and bricks and roofs and electrical and plumbing, but there's people there. There's people managing, and you need to take care of those people.
You need to.
And,
yeah. They, I mean, they're feeding you. They're paying your rent. They're living there, and you have to take care of them. You have families with babies, and it's just you got to take care of these people. They're living in your property, and they have to see that you're. I mean, when you show concern, it's an amazing thing.
Yeah.
They'll
They're
do
the
right
valued
thing.
customer client. We treat them with just like you're saying, and
Thanks.
I know you will too. That's how you have to do it, and it makes a
Exactly.
big difference. Not only you feel good, it's the right thing to do, but also you'll probably make more money. Even you will relationship, and you got to watch it. You got to watch the business and watch and take care of people.
Yeah. Well, the amazing thing with this business is you're not managing the property on your own. If you have good systems in place and a good team, you're just managing the manager, which is not something that some people may think. It's a substantial amount of time that they have to invest in, managing a property or running after rent. And if you get a really good, solid property management company, you're managing them, which is not much, just following up, verifying everything's okay. One thing that was very helpful that I learned was from you was the screening process of tenants. You sleep much better at night. You don't have to worry about anything, or verifying 2 or 3 of the last landlords. It's so important to do that, because the current landlord that they could be living with, they could be destroying the property. They want them out of there. So they'll tell you whatever you want to hear. But the second or third previous landlords, if they have nothing but good things to say, I mean, it's A-okay, just get them in the property. And
That's right.
surprisingly, the property management company I use is so good that they suggested it before I even wanted to suggest it to them. So it's key getting a good management company.
And managing the managers every month, watching, because they're people, and there you go. But go ahead.
Well, what do you think? As we're discussing team, how instrumental is it to have a really good team, and what are some of their roles when acquiring a multifamily, managing, and at the end of the day, disposing of it once time's up, 7 to 10 years.
Whatever you and your investor's goal is.
Yeah.
Sometimes we want to hold forever. Sometimes we sell. Sometimes we don't want to sell, and we sell because we get an offer.
Yeah.
You're like, wow, okay, we wanted to hold, but we can't afford to. They're offering us so much money. That will happen over time. But you got to get in the game. You got to get started. People have fear, like I did, and get started, do the deal. But the team's the key. Any business, you have the system. You can have a great system, but if you don't have a good team, it doesn't work. Who's the main part of your team? First, construction, if you have to do repairs or you repair some of the units, correct?
Mm-hmm.
And,
yes.
I know you've learned our system. You have systems for that. Again, patterns, show us the last 3-4 jobs. Well, were you on time? Were you on budget? Number 2 is the management's key. I've had great properties that I didn't follow the system and in a month or 2, the manager went down. You've got to watch the managers like any business. Sometimes they're great for, that's really the key. And of course, the next one is having, the preparation. You make all your money when you buy the deal. You got to buy it right. You got to do your research, run your numbers. And we actually send our manager, or I've done it, and I know you've done this, actually interview all the tenants. You'll find out about the area. Then, of course, you need a good broker who either helps you buy it or sell it or comp it to make sure the value's there. And of course, you already have the good attorneys, good accountants to keep track of everything. That's kind of the technical stuff. But people don't realize, do it, because every month or year you don't, you're not getting the cash flow, you're not getting the equity, you're not getting the tax benefits or the appreciation. And you have a good team, and you got to watch the team like any good, you're investor, CEO, which kind of you are when you do the investing. So that's the key.
Yeah, no, for sure.
Those are some of the key players.
Yeah. Well, it's just the benefits. There's just so many benefits with the multifamily, with the leverage, with appreciation, depreciation, the cash flow. How do you feel that asset class multifamily differs from say, the stock market. And
I just mentioned cost segregation, which a lot of investors don't understand. I know I didn't. I know myself. A lot of investors didn't even know about it. I know you have a great source for that. And what is it? So the benefits, most people buy multifamily: cash flow, of course, equity, tenants are paying the debt off. It appreciates over time, hopefully, if you're doing it right, which over time is nice. And the other thing is tax benefits. And everyone's different. And I know you have good accounts for this, but give an example. Just for owning the building, the investors who are involved usually get to write it off over, I think, 27 and a half years, if I'm not mistaken, about 28 years. So if you buy a building for $2.8 million, not the land, you get a $100,000 write-off each year that you hold it, besides the other expenses, travel, accounting, any expenses that come like interest and things. So just for owning the building, there's usually a benefit for many people. And when I learned about cost segregation, which we've talked about and you know about, our account says, listen, the carpet doesn't last 27 and a half years. So we're going to ethically, legally write it off over 5 or 7 years, depending on the market, the carpet, the windows, the paint. So all of a sudden, it's getting a $100,000 a year write-off that we share as investors in the group as it's structured. We might get a lot more write-offs. And if it works for you, which it does, you have two choices. You can pay taxes with cash or check, credit card, or you can pay it with write-offs. And my advisors, and I know yours too, say a better way to do it is write-off. So if you own enough real estate and you qualify, you may have your tax liability reduced. When I worked for somebody else or bought and sold stuff, I paid a lot in taxes. And then when I started owning and controlling and enjoying this benefit, my tax bill went way down, and it still does. And that's just something a lot of investors don't think about. And it's a real advantage for most people. Of course, I'm not an accountant, I'm an investor. And I know you have the teams, the attorneys and CPAs and cost segregation people to help you and the investors structure it properly and protect everybody.
Interesting. Yeah. And, the thing is when you're looking for or trying to acquire these multifamilies, like I said, mom and pop owned, they're unfamiliar with these ideas, tactics and whatnot to improve their cash flow. And you just see all these windows of opportunity, how to improve it and just, raise the cash flow and value of the property. And, it's really incredible what you can do, and the tax advantages and leverage, cash flow.
I know. In this podcast, you hear a lot of information on something I didn't know until many years ago was self-directed IRAs. A lot of people have money in pension plans and IRAs, and the company or some company says, here's what you get to choose. And then a lot of people don't know this. You can, in many cases, do a self-directed IRA or pension plan and invest stocks, bonds, Bitcoin, whatever you're into, gold, and real estate, which is a big avenue that when we showed that, some of our investors are like, wow, nobody told me that. And again, these are all specialized areas that, takes time to learn and understand, which, people need to do, and you've done.
Yeah. So it's unbelievable. Just,
it's exciting.
Yeah, it really is. What are your thoughts on, the asset class of multifamily, like A, B, C areas? Obviously, probably want to stay away from D and F war zones.
I've made money in D and minus and F and Q,
Interesting.
And first of all, every investor is different. As we train, understand this. People need to set their goals, what their risk tolerance is, understand. But remember, as an investor, I'm not living there. I don't have to hang out there, so a lot of people, when I got started, I don't like that street. Well, I don't like it, but I'm making a lot of money there. Now, if you line up 100 of our super successful multifamily investors, you'll probably get 115 idea answers.
Yeah.
I only like A minus, the best neighborhood, long-term, really great people in areas, the A stuff, beautiful, high, the place I would mind, living in or renting in, or vacation rentals. I've done that. A lot of people say I like a B minus, B, not the nicest, but something I can buy and upgrade a little bit, get a little more rent and work a little bit and get it up to an A minus. Then a lot of our investors say, you need to know what you're doing. I love C stuff and C minus and rougher areas that's improving, and we can improve. And I have a lot of investor friends and students, and I've done it, that have made good money in the really not so great areas. Because remember, people live, rent everywhere. You just need to understand the area, the risk rewards, and can we manage it? How much will we collect? The numbers, and people pay rent in great areas and they pay rent in not so great areas. So lots of opportunity. And that's something you need to decide. Appreciation, cash flow. The cash flow on some of the B minus, C minus stuff is if you know what you're doing and can manage it, is amazing.
Yeah. Yeah, exactly. Especially if you're finding like a C-class property in a B area and a lot of room for improvement.
Absolutely.
You know,
so it's an individual decision, and a lot of groups, funds, and investors and syndicates choose different class areas. Some are diversified. I've been diversified. I do C, B, and some A minus stuff over time. But the main thing is, is get started. I thought about it for years, worried about it, didn't know about it, and I'm like, why did I wait so long to go into multifamily? It's, I look back and I just wasted so many years.
Yeah. It's a shame when you procrastinate and just don't jump forward on it, and get started investing in multifamily. What are your thoughts in regards to areas in the United States to invest in multifamilies, like East Coast or like cities like Florida or Cleveland, where I'm located?
Everyone always asks me, where's the absolute best market? And we don't do markets, we do deals. You need to know what markets you're in. You need to understand your market, the pros and cons and economy and rents. And it's not that, once you know how to do it, like, you've learned, it's not that hard to do. There's opportunity everywhere. As you know, we have over 1,000 international investors who don't care where it is, as long as it's a good investment, decent area, they're going to collect the rent. So I tell people there's no real estate market, like no stock market. There's micro markets. And, it's interesting. And we find that there's opportunity everywhere. But we kind of like, and this is my opinion, people make money all over the place, is the kind of middle of the country. When the markets are good, like they have been recently, and of course now they're moving around, and more motivated sellers now, I believe, my opinion, is, LA, Beverly Hills, Manhattan, super competitive,
very volatile, maybe.
I'm sure there's some deals there. I've done some over the years. It's tough. But when you go to what I call, and my mentors taught me this, what I call the secondary tertiary cities, like the Indianapolis, the Clevelands, the Columbuses, and again, they're in every state. One of our head trainers does Montana. That's not the first thing that every investor's thinking of. They're thinking Miami, New York, LA, Vegas. The other thing is legalities. I'm lazy. I like to go where it's easier, where their deals are easier, and where they're more investor, landlord, landlady friendly. So there's certain pockets, maybe rent control in New York or Santa Monica, where we choose not to, the rules and laws, which is fine for some people, but not for me. And as an investor, you choose your investment and you analyze it, and you either renegotiate, move forward, or to get out, as you know. And there's deals everywhere. We've seen them everywhere.
Yeah. Like you said, a deal is a deal.
Numbers and investor mentality, not the consumer mentality. Exactly. You don't have to live there. You don't have to have dinner there every night. You have to hang out there. It's completely different than picking your own home or your own apartment. And that's, I think, a big mistake a lot of investors made. I kind of did too. Well, I don't like that, or that's too expensive, or hey, it makes money. We're an investor.
Yeah, and some people may get emotionally attached to a particular area. They just like the area, the city. But at the end of the day, all that matters, the numbers, the legalities, like it's a landlord-friendly city. Is there a really good deal there,
Yeah.
And
I tell you, you can be passionate about it like you are and I am, but save your emotion for your family, your faith, your sports, your whatever you're into, your hobbies as an investor. And that's a big shift for some people. It looks too good, or it doesn't look good enough, but you have to know your local market. And I tell people, there's Ruth Chris and gourmet restaurants. They do well, I guess, when they can. And then there's Burger King and Subway and Billy Bob's Cafe, and they, do well. There's Ritz-Carlton, and there's other hotels. And again, it's depending on as an investor, the emotional attachment is a big point that you've made that people need to understand. I think it's something a lot of investors don't understand, and they do get, my husband doesn't like that area, my wife loves this area. Well, that's nice to live in or shop in, but we're investors.
Yeah, exactly.
There's a lot more Walmarts and dollar stores than Tiffany's.
For sure. Well, is there any type of advice that you would that you could give to new investors getting into multifamily, or any tips, pointers, just initially getting started out investing in multifamily?
Yeah, I think the biggest mistake people are worried about mistakes, correct? And you have to know what you're doing. You, as an investor, you have to understand the deal, ask the questions, and you have the team for that. The person who's putting together, the lawyer, the title company. But the biggest mistake I made is not getting started, overthinking, overanalyzing. You got to know what you're doing. Everyone's responsible for their own investments. But that's a big mistake people make. I analyzed for a long time, and it's fear-based. And don't operate out of fear, operate out of knowledge, good team, good questions, and then make a logical decision. Listen, I wish everyone who's listening would have bought every apartment building 20 years ago or 15 years ago or after the crash. Or, they wait and wait and wait for the perfect time. You said something that's interesting. There's no perfect deal, but there's good deals. There's no perfect time, but there's always a deal every time. And I'm one of those things, we're buying for the long term, and cash flow works. Have your money work for you. And multifamily is good for a lot of people, good diversification. And, you check on it and watch it. But it's funny. I have a lot of people that work hard, and every month I travel a lot. And I'm like, the rent keeps coming in, and it keeps going up, even in, weird times, and it keeps coming in. Yeah. The tax benefits keep coming in. The appreciation sometimes slows, sometimes moves around a little bit, but over time, because we're long-term investors, we're not buying and fixing and selling an apartment building in 3 weeks or tomorrow. So they're like, what about now, the markets? I'm not buying to sell next month or 6 months. We're buying for 2 years, 5 years, 10 years, 15 years, whatever your horizon is, 7 years. And it's amazing. And I will say this, most of my multifamily worked out a lot better than I anticipated. And I know that's true for a lot of investors. There's always problems. There's always risk. And you know what you're doing. But I want to say that again. Most of the deals I know for people who know what they're doing, it's worked out a lot better over time than they thought.
Yep. You hold on long term. And whenever I'm analyzing a deal, I go in trying to talk myself out of the deal. How could it not be a good deal? So I'm really just a lot of verification on the numbers and double checking 1,000 times, to ensure everything adds up properly. And, but I guess that kind of basically wraps it up. I greatly appreciate you being here today on the podcast. And
thank you, Eric, and congratulations on what you're doing. And I know you're going to have a lot of success. And I want to wish everybody who's listening, paying attention. Hey, you meet with good people, and I've known Eric for a while. We've done some stuff, and man, sharp, good, and he cares. That's one thing very important about investing. Some people are great investors, but you need someone who cares about the property, cares about the business, cares about the investors or the deal. I care. I know you care. That's a big deal. So I want to say, good to be here.
Yeah, thank you so much. And if you guys like to check Robert Shemin out, you can check out his website at www.robertshemin.com. If you enjoyed this podcast, please subscribe below. Thank you so much, and have a great day.
Thank you for listening to today's Metro Blue Capital's podcast. For more information, please visit metrobluecapital.com.